Thank you very much. Well, I don't think we need to have a long introduction. I think we should go straight into your presentation, actually, and then we'll have questions afterwards. So, fire away.
Excellent. Well, thank you, everybody, very much for having me here today. Been very excited to talk about some of the events that are transpiring because I think there is an interplay between the geopolitical and the economic and the monetary becoming very acute in ways that haven't happened all that often in the past 50 to 70 years. And so I'm excited to talk about some of these things. We're going to jump right in. I'm not going to have you read the whole first slide, but the key here is that if you view what happened with U.S. repo rates spiking 2 months ago, and by way of quick background, U.S. repo rates, repo rates are a key area where asset markets are financed in the very short term in the United States. And unexpectedly, mid-September, they spiked from under 2% to first 6% and then to 8 or 10%. And the gist of this suggests a supply-demand mismatch in terms of supply for money, demand for money. Why it was important is because ultimately primary dealers finance much of their books, including Treasury holdings, at the repo rate. And so if repo rates were to stay at the 10% rate for very long, eventually U.S. Treasury rates would move towards the repo rate. And of course, no government on the earth, much less the United States government, could afford to finance for very long at 8 to 10% rates. And so we had this repo spike. By way of background, we think this is a critical moment in terms of a series of events that have been transpiring. And what we say here is that if you view this repo rate spike through a historical geopolitical lens, it suggests that the core issues that drove the repo rate spike are neither temporary nor technical. And right now, that is the overwhelming consensus on Wall Street, is that they were temporary technical issues related to regulatory pressures, et cetera. And where we start here is a quote from former Greek finance minister Yanis Varoufakis when he was on doing a book tour for his book, The Global Minotaur. And I'm not going to read the whole piece, but he lays out how Henry Kissinger asked Paul Volcker, who was then a young banker, to come up with an idea for how the U.S. could retain its hegemony once it began to run a deficit position. Because historically, once empires had run deficit positions, that began to be the end of the empire. And in this letter that Varoufakis cites, he said that if we can't remain hegemonic, which was the word that Volcker used, if we can't remain hegemonic by handling our own surpluses, then we need to start handling other people's surpluses. And so the U.S., to retain its hegemony, decided to run bigger and bigger deficits and then recycle those other countries' surpluses as a way of retaining hegemony. And so I think it's an important place to start by way of background for where we're going to get to in terms of the repo rate spike, how it ties into geopolitics, and what it means for the dollar. So then we go to the next slide, and we see here, Volcker's plan was a masterstroke for certain interests in the United States. The United States government was able to borrow extremely cheaply, ad infinitum, basically continue to roll debt without question. U.S. finance sector benefited. U.S. consumer finance sector and consumption more broadly benefited. But other parts of the world were less sanguine about what the United States did in 1971. And here's a tweet from last year from Martin Selmayr, former Secretary General of the EU and Chief of Staff of Jean-Claude Juncker, highlighting that in August of 71 we went off the gold standard. He noted that Europe had to react and started work on a monetary union that eventually led to the euro, and that Europe needs to take its destiny into its own hands. And so something important happened when the euro was launched. The data from here is from a paper Ben Bernanke put together in 2005. And what these bars show you, the blue bars are 1996, and they show you the U.S. running a deficit primarily financed by the euro area and Japan buying our treasuries, and developing Asia and China doing de minimis in terms of financing U.S. government deficits. And that was in 1996, pre-launch of the euro. And what you can see in the orange bars post-euro launch are the U.S. running much bigger deficits, the euro area's contribution to financing those deficits dropping off to virtually nothing, picked up by Japan, developing Asia, and that was just at the very start. China had begun financing U.S. deficits. And so what you could see here is post-Euro launch, European Union surpluses began to be recycled more into the European Union instead of into the United States. And so after the launch of the euro, the U.S. needed to find somebody new to finance its deficits for us, to sterilize our deficits. And what we show here are Chinese holdings of treasuries. We got China into the WTO in December 2001. At that point in time, China owned $60 billion of treasuries, and over the next 10 years, that number grew to $1.3 trillion. And so we just make a note here that, as much as the United States government and China are getting into it now, while this number was rising non-linearly from $60 billion to $1.3 trillion, we love the Chinese government. We love China, and we were looking the other way on a lot of the things that we now consider issues. Now, underlying this whole situation was the expectation that global central bank demand for Treasury bonds was going to increase, which is the blue line at bottom, and the U.S.'s supplying of those Treasury bonds was going to slow, the red line at top. And so there would be this convergence. This is a chart from the BIS, and the dotted line started in 2014. This is a chart that comes from the Treasury Borrowing Advisory Committee, or TBAC report, that is produced quarterly in the United States, and it dovetails with what we saw on the prior slide from the BIS. This is the weighted average maturity of all U.S. Treasury bonds outstanding, and the plan in 2014 was for the United States, as you can see in green, to term out their debt longer and longer dated up and to the right, which makes sense given high levels of debt and the low rate regime we were operating in. However, as they say, we plan, God laughs. Instead, what happened was the exact opposite. U.S. supplies of Treasury bonds accelerated on the upside, and demand for Treasury bonds from global central banks actually fell, led by China, who in late 2013 said it was no longer, the PBOC said it's no longer in China's favor to boost their record FX reserves. And so instead of a convergence between supply and demand for U.S. Treasury bonds at the global central bank level, we actually had a divergence. And that divergence comes through in this chart that we showed just a moment ago. The weighted average maturity of U.S. Treasury bonds outstanding, which was expected to move up and to the right, actually stayed flat to fell at a time when we were in the strongest bid for long-dated bonds in 5,000 years. We've had the lowest rates in 5,000 years. Of course, just recently, we've been up to $17 trillion in negative rate debt. And yet, for some reason, the U.S. government has had a hard time extending the weighted average maturity of its debt. And there's really only two most plausible reasons this is the case. Either the U.S. Treasury is unsophisticated and doesn't know that there's a strong bid for the strongest bid for duration in 5,000 years, or what they indicate, or what consensus believes to be very strong demand for long-dated U.S. Treasury bonds is not nearly as strong as they say for some reason. What you can see, I apologize for the small print up there, what has gone on, and the reason why weighted average maturity has fallen the way it has, is because U.S. government issuance has been forced to the front end of the curve. What this table shows is that the United States last year in fiscal 2019 issued $11.5 trillion on a gross basis. That's both new and rolling over existing debt. And at this point in time, through the third quarter of last year, fiscal third quarter, 55% of that was done at 6 months and under. Actually, the latest numbers have come in for full year fiscal 19. 71% of the United States' debt is being rolled at 6 months or less. And so when we've been reading about what happened with the repo spike, what happened with Fed funds rising over interest on excess reserves, the signs of dollar tightness within the United States' own banking system, we've been hearing about this being a surprise, about it being temporary, about being technical. What this chart shows is that the bid-to-cover ratios at Treasury auctions for U.S. Treasury bills, and where that number peaked and began falling down and to the right was just about the exact same time that the Chinese said we're done buying Treasuries. And so what this tells us is that this isn't temporary, it isn't technical, and it should not have been a surprise. There have been these seismic pressures building under the surface for over 6 years. So we have to start asking, why did China do this? Was this a purely economic decision, or was it geopolitical in nature? And what this is a quote from a speech from 2015 by PLA General Kiao Lang. Again, I'm not going to read the whole quote, but one thing I will highlight is the last paragraph, which is that he notes that it is essential for the U.S., the way we've structured our economy, to recycle capital back into the U.S. economy contiguously. And he said, the Americans only have this one way to survive now. We call it the U.S.'s national survival strategy. The U.S. needs a large amount of capital flowing back to sustain its daily life and economy. If any country blocks that capital flow, it is the enemy of the United States. And so you can see this sequence of events where the Chinese stop buying treasuries, and the tone in the United States regarding China has gotten continuously more hawkish pretty much ever since. I thought this was a great quote from Graham Allison at Harvard, author of the book Thucydides' Trap, where he said relations between the U.S. and China are destined to get worse before they get worse. And we used this as a title of a presentation in 2018. We thought that then. Unfortunately, we think it's probably likely to continue now. And the reason we think that is because the trade tensions between the U.S. and China, we think, are merely the symptom of a much more fundamental structural disagreement, which is that it's a matter of national security to China to move away from the global monetary order as it exists, centered around the dollar. And it's a matter of national security for the United States not to allow China to move away from that dollar-centric order. So we say, well, why is it a matter of national security for China to move away from the dollar-centric system? And the yuan bear case, in a nutshell, is really comprised of two things. Number one, Chinese tourism growth is putting downward pressure on China's current account surplus as dollars flow out of the country with increasing amounts of tourism around the world. And point two, which is as China imports more and more commodities, oil and gas in particular, they have to pay dollars, and as their volumes go up and the price goes up, their current account surplus will dwindle and eventually go into a deficit, at which point they could experience a balance of payments crisis similar to what we saw in Southeast Asia or any number of other emerging markets over the last 20 to 30 years. Now, the key here is that the worst case, the current account deficit, actually happened in the first half of 18 for China for the first time in at least 20 years. As you can see in the maroon line here in this chart from The Economist. And so we ask, why does that matter? And why it matters is that the current account deficit position puts China between a rock and a hard place. If they want to avoid the same fate as Southeast Asia with all the attendant domestic political instability, they have to take some sort of major action relatively soon. And when we wrote this in the middle of 2018, the consensus was that China would be comfortable playing the long game. And our case was that China wasn't going to have the luxury of the long game once that current account went into a deficit position for the first time in 20 years. So again, I apologize for the small print for here. It is in your packets. This is a decision tree we put together starting at the top of what happens when China runs a current account deficit. And they have a series of potential options. And options 1 through 3 are pretty classic emerging market options, right? You can slow the economy, slow the amount of commodities you're importing. That increases, disruption, runs the risk of political instability. You could sell FX reserves to fund the current account deficit. You can do that for a while, but eventually markets are going to see you have finite FX reserves. You're going to move towards a late 1990 situation, disruption, political instability. You could devalue the yuan. They've certainly done this a little bit, but again, you go too far with it, disruption, political instability. And then the final option is the fourth option at right, which is accelerate the pricing and settlement of Chinese commodity imports in their own currency, in renminbi. And that, since early 2018, is clearly what they've been doing with the rollout of, and probably earlier, the rollout of the renminbi oil contract in early 2018, Holy Grail gas deal with the Russians as early as 2014, increasing settlement and pricing of iron ore in renminbi, et cetera. And so the key here is at the bottom, which is that avoiding disruption, once China ran a current account deficit, avoiding disruption was really no longer on the menu of options for China. It was now have disruption and remain a vassal of the dollar system, or not avoid disruption and basically achieve their economic sovereignty vis-a-vis their commodity import bill and avoid mitigate the risk of a balance of payments crisis, as you saw in Southeast Asia, and we think they've been choosing the latter. So then we turn this around on the other side of the same coin, and we say, we highlight this chart, which since 3Q14 we've said is the most important chart in macro, which is in 3Q14, for the first time in 70 years, global FX reserves at central banks stopped rising. And so back in the mid-2000s, U.S. Vice President Dick Cheney famously said that Reagan proved that deficits don't matter. And that was absolutely true for as long as global central banks were sterilizing our deficits as their assets. And what this chart shows is that stopped 5 years ago. And we think the reason that stopped ultimately is tied in no small part to China stopping growing their holdings of treasuries, which is in no small part tied to their need to de-dollarize their commodity import bill. Because once they can buy commodities in their own currency, their need to stockpile treasuries begins to be permanently and structurally reduced. And so once global central banks stop buying treasuries, someone else has to buy treasuries. And what we can see here, this is Treasury and agency securities as a percent of total U.S. bank assets in blue, which began in 2014 rising sharply. And the red line is U.S. banking system cash as a percentage of total assets. And so what you could see that as the global central banking sector stopped buying treasuries, the U.S. And global private sector had to begin buying those treasuries instead. And it led to, from the period of 2014 until recently, dollar strength, global dollar interest rates rising. Basically, the U.S. government began crowding out the entire world of dollar borrowings. In addition to U.S. banks buying more treasuries, U.S. money market funds were regulated into buying more treasuries through U.S. money market fund reforms of 2015 and 16, where the U.S. money market funds bought an additional $1.3 trillion in treasuries and agency securities that amounted to $1.3 trillion in QE. They didn't have to call QE. And so the action of global central banks ceasing to buy treasuries touched off this vicious cycle that began 6 years ago and has continued spinning and likely will remain engaged as long as global central banks are not buying treasuries, which we think is going to continue for the reasons we highlighted vis-a-vis China. And so in this vortex, we start at the top. Deficits rise for the U.S. That drives an increase in U.S. federal borrowing due to either a fall in tax receipts or an increase in spending, and then we move over to 2 over at the 3 o'clock position. Since foreign central banks aren't lending to the U.S. government anymore, the U.S. is forced to borrow from the global private sector. We go down to the 6 o'clock position. Since U.S. federal borrowing demand is secularly rising by a significant percentage of private sector income growth, the federal government begins crowding out global dollar markets, sending dollar-related interest rates higher and the dollar higher. And then number 4 is the U.S. federal borrowing crowds out the global private sector. You have rates rise. It slows the economy. You go back to the 12 o'clock position, slowing economy, bigger issuance. So the global central banks ceasing to buy treasuries, led by China for domestic national security reasons, has now touched off this balance of payments vicious cycle in the United States. It's been spinning since 2013, and it's accelerated markedly in the past 12 to 14 months. And so we fast forward, 6 months ago now, back in June, 5-6 months ago, we said that these developments, 5+ years in the making, appeared to be coming to a head as the dollar shortage in the U.S.'s own banking system, driven by that vortex, was likely to force the Fed to either have to inject new dollar liquidity into the system with equities near the highs and unemployment at 60-year lows. And so we thought the number one thing to get right in the back half of this year was, when push came to shove, would the Fed cede control over the quantity of money to control the price of money, basically to stop U.S. short rates from rising? They would start growing their balance sheet again. Or would they cede control over the quantity of money or would they cede control over the price? Would they cede control over the price of money and control the quantity of money? So basically not grow their balance sheet and let rates rise, or would they control rates to politically expedient levels and begin growing their balance sheet again? And of course what we saw, push came to shove 8 weeks ago, this repo rate spike, where this is one of the best quotes I've seen from Bank of America's Mark Cabana. It looks and smells an awful lot like the monetary authority is financing the fiscal authority, and that's exactly what they're doing. The issue here and what ultimately brought this to a head in the manner in which it did, and again, I'm not going to read the whole article to you, it began in early 4Q18 when FX hedged Treasury yields actually went negative. So basically, if you remember, global central banks stopped buying Treasuries, then the global private sector picked up the demand or picked up the slack. And the way they buy them, Treasuries, they buy the Treasury, they buy a hedge against the dollar, and what is left over is the net effective positive carry, their net effective yield. In fourth quarter of last year, the cost of hedging U.S. dollar risk rose so much that it more than offset the yield they were receiving in Treasuries. And so if you wanted to buy Treasuries on an FX hedged basis beginning in early fourth quarter last year, you had to accept a negative nominal yield, which can be seen right here. So the big red arrow, this is the 10-year Treasury yield, FX hedged for European and Japanese investors. And so not only has it continued to be negative, but it's now still basically on the lows between negative 80 and negative 120 basis points. So far from being the most positive yield out there, actually adjusted for FX hedging, U.S. Treasuries are amongst the lowest yielding instruments of the major sovereigns. And so as soon as that, the red arrow correlates to the same time frame, U.S. primary dealers had to buy a lot more Treasuries because they're legally obligated to do so at U.S. auctions. And in the fourth quarter of last year, they grew their holdings of U.S. Treasury bonds by a $600 billion annual rate, which is an absolutely astounding number. This dynamic continued to crowd out the U.S. banking system as the negative FX hedge yields forced the U.S. to finance more and more of its own deficits. On March 20th, where you can see the red arrow, Fed funds rates went over interest on excess reserves. It's kind of a technical highlight, but Fed funds is just an interbank lending rate. Interest on excess reserves is the rate the Fed's paying on excess reserves, and the Fed funds rate should never go over excess reserves because the banks can make a risk-free profit simply by taking money out of excess reserves, lending it into the interbank market. But for some reason, beginning in after March 20th, they have refused to do so. And our case is that the crowding out of the dollar markets in the U.S.'s own banking system, that basically what they're calling excess reserves are not excess reserves, they're minimum reserves. This next chart is further supportive of that. It's a supply of Treasuries problem, not a banking system problem in the United States. This chart is U.S. repo balances in black at the Fed. So this is when they are doing these repo programs to inject liquidity versus repo fails. So the soft gray line or the light gray line are fails to deliver. So when the banking system starts to have problems, if it's a collateral shortage, what you'll have is the repo transaction will take place, somebody lends Treasuries, gets cash, and then it's time to reverse the transaction, and the guy holding the Treasury says, no thanks, I'm not going to redeliver the Treasuries. That's a fail. And so what you can see over here on the left, in 2007 and 8, when we were having a banking system crisis, repo fails were spiking with repo. There was a collateral shortage. This time we have the Fed engaging in repo again, but the fails aren't really moving in any real way. And so what it suggests is that there is too much collateral, not enough liquidity, as opposed to 2008, when we had not enough liquidity, not enough collateral. Now, what's interesting is these banks are facing this collateral versus cash mismatch already, and collateral supplies, aka Treasuries, are never stopping, which you can see here. This is the U.S. federal deficit or surplus as a percent of GDP. And so from 1983 to 2000 on the left-hand side, U.S. federal deficits as a percent of GDP were shrinking long-term, and actually we got to a surplus position for a couple years right around the turn of the century. Since then, it's been trending down, lower highs, lower lows, and what the dotted line over at the right shows what would happen if the U.S. entered a recession right now. That is just counter-cyclically what happens to the U.S. budget deficit when we run into a recession. And the important takeaway here is that we're already having a mismatch of supply-demand for Treasury. We're having trouble financing our own deficits in our current state. If we have a recession, someone's going to need to buy somewhere between 600 billion to 1.6 trillion more in Treasuries. And the only buyer for that's really the Fed. No one else has the balance sheet. This is a little bit of a different version of the same chart. We think these Fed liquidity injections from here on out are likely to be quote-unquote permanent because, at least until the dollar weakens significantly, because the collateral supply growth is likely to be large and permanent. What we can see here is that Congressional Budget Office table of federal debt as a percent of GDP. The last time debt levels in the United States were at this level was in the immediate aftermath of World War II. To delever from that required a historically unique combination of high inflation, rebuilding the world after World War II. We constructed the Eisenhower highway system. We engaged in the Cold War with the Soviets, and it still took a long time to work that down. What we show over here on the right-hand side of this chart is that the U.S. CBO estimates all never include any recession outlook. They're 10 years forward, no recession. So this outlook assumes the United States does not have a recession until at least 2029, and if we do, this chart would probably look like the black line. And again, the U.S. is having to finance its own deficits. And so as a result of all of the preceding, all year we've been showing this chart to our customers, which is U.S. Fed balance sheet versus as a percent of GDP versus the Bank of Japan's balance sheet as a percent of GDP, with the BOJ lagged 10 years. And our question was, when's the U.S. going to have to basically begin growing the balance sheet again? And thus far, we've not been disappointed. This chart was updated a couple weeks ago. We have now undone 10 months of QT, in just 7 weeks. We're back over $4 trillion on the Fed balance sheet remarkably quickly. And again, that line below is without a recession. If you remember this chart before from the money market funds, we've already sort of used money market funds as a stopgap solution. And so if we cut rates too far, ostensibly some of the money in money market funds will flow out. These guys are also lending into repo markets. So if the Fed cuts rates too fast, they may actually make the problem worse, not better. And so their operational maneuverability is less now than it was in 2008. And what we say is last time we saw something like this, and there's a number of different analogs we use for describing what's happening, but the last time the U.S. saw something like this was in the late 1960s. This is a chart showing federal deficit as a percent of GDP in blue, U.S. unemployment, which is inverted on an inverted scale, in red. And so we frequently hear or are asked, is this like 2008? Is this like 2001? Is it like 96? Is it like 1990? And we say the answer is none of the above. The answer is it looks a lot more like the late 1960s when LBJ was doing guns and butter and unemployment was extremely low. And in the same way, history's rhyming. Back then, the U.S.'s major creditor was a European community, and for a while they absorbed treasuries and did not redeem them for gold, and then they started to redeem them for gold, and that led to a series of basically the U.S. government being cut off from by its foreign creditors, led to the U.S. withdrawing from Bretton Woods, the 70s, etc. And here once again, as we showed earlier, global central banks have stopped buying treasuries on a net basis as of 2014, but one thing they are buying an awful lot of is gold. And we've called this a Eurasian currency bloc. It's sort of a quote-unquote rogues gallery, as the United States defines it, of China, India, Kazakhstan, Mexico, Russia, Turkey. But and more recently, a number of European nations have joined this Eurasian gold bloc in reserving gold instead of treasuries, in a move that is reminiscent of what happened in the late 1960s. And so where we boil this all back to the repo rate spike and what it means to the dollar going forward is that just like in the 60s, just like in 2000 when the European Union stopped recycling U.S. deficits, the U.S. needs to find a new external financier of deficits. And there's a few possibilities. The first is Africa, which is possible. The way to think about that is the United States needs to find something that it can run a 100 to $400 or $500 billion per year deficit against the continent of Africa in. And so oil with Nigeria, maybe certain raw materials, etc. Perhaps the challenge within that is that China has already bought up large stretches of Africa with the dollars we gave them. Mars, Venus, Jupiter is tongue-in-cheek. They would be nice to have, but it's not happening. And the answer number 3 is the Fed. And we think that's what just began happening with the repo rate spike and the Fed's response to the repo rate spike. And so when you say, what does all of this mean, what's likely coming, there was a white paper put out by the BlackRock Investment Institute back in August. And it takes a lot to drop my jaw these days. This paper dropped my jaw. And the reason it did is both who wrote it and what it said. So the authors were former Fed Vice Chair Stan Fischer, former head of the Swiss National Bank Hildebrandt and the former Bank of Canada Governor Jean Boivin. And the gist of it was, in the next crisis, in the next downturn, we are going to bypass the traditional interest rate channel. And if long rates rise as a result of that, we are going to grow our balance sheet to cap long rates. We are basically going to stick it to people at the holders of long bonds, long sovereign bonds. Importantly, this was echoing something the Fed began talking about earlier this year as well. Lael Brainerd at the Boston Fed and Vice Chair Clarida both talked about this in the first half of this year, talking about what we did during World War II where the Fed capped yields. You can see where the Fed capped yields during World War II in this chart. And so we were in a long period of deflation, obviously, from the mid-20s to the late 30s, early 40s. Japan Bob's Pearl Harbor, where the big arrow is, yields back up because war is very inflationary. And then the Fed says, we will buy every 10-year Treasury you issue at 2.5%, no questions asked. And you can see from 1942 to 1951, the 10-year never went above 2.5%. And so the good news for 10-year Treasury holders is the blue line below, which is you got every dime you were promised and you clipped your 2.5% coupon. The bad news was that CPI is the gray line, and it rose 4x in that same time frame. And U.S. stocks rose 5x in the orange line in that same time frame. And so basically, Treasury bonds were made certificates of confiscation basically as a matter of U.S. national security. And so what's interesting in the context of all of these pressures that have been built up over the past several decades is IMF did a white paper in 2015. It was called The Liquidation of Sovereign Debt. And what you can see here is, the developed nations are in orange, the emerging markets are in green. And once you get to debt levels in the developed markets where we are, regardless of whether it's in a developed market or an emerging market, these are always resolved the same way. You default, restructuring, conversions, and a few hyperinflations. It doesn't go well on a real basis for sovereign debt holders. Now, fascinatingly, as all of this setup is happening, as we're seeing it develop, consensus and sentiment on what is happening can be seen here. You can see Bloomberg Business Week from April, is inflation dead? Economist from 2 weeks ago, the end of inflation. And it reminds us of the Business Week, the famous Business Week cover over on the right-hand side, the death of equities. That was August 13th, 1971. And so sentiment loves, of course, we were just at 17 trillion negative rate debt at a time when it seems very clear to us this unique historical set of pressures that have been building up for half a century are coming to a head with this repo rate spike and have now already forced the Fed into action. And so the question becomes, as we relay it to our customers, how do we make money with this? But I think it would be a great jumping off point for our conversation, which is, to us it seems possible that both equities and bonds have it right. Bond yields don't necessarily have to sell off like they did in the 70s. They're about to be capped. Equities should do well. The markets that we think are mispriced are currency markets, and in particular, the dollar. And from here, the key questions will be psychology. When do more investors begin to realize what's happening here, that if you're sitting at the long end of the Treasury curve, you're the frog being boiled in the hot water, and the water is starting to get very warm. And then, the dollar. When does the dollar start to reflect this? It's sold off a bit since the repo rate spike, which is unusual because the repo rate spike is ultimately a symptom of dollar shortage. So the dollar should have risen on that, but didn't. But that is I think, a good place to summarize. Ultimately, I think to summarize it, this repo rate spike, as we say here, is merely a symptom of what's effectively a U.S. balance of payments problems. And that has very big economic and geopolitical consequences that I think we are in the very early innings of see play out in both geopolitics, economics, and markets going forward. So that's